John Hirtle is executive chairman of Hirtle Callaghan and joins us now. John, thanks for being with us. What's been your general sense of the mood of the market so far this year?
Good morning, John. Market's relatively positive. We're always surprised in recent years how they can walk away from all the international crises that are going on. But we've learned that over the last several years here that we can walk through crises, and Mark always tries to look past that valley. So market's generally positive. We're fully invested, and so things are fundamentally positive.
And on that interest rate dialogue, which seems to have been an obsession point for the market, certainly over the last few weeks, a reminder to our audience that there was a growing belief in the market late last year that if inflation was improving and the economy wasn't necessarily falling apart, there would be a case for interest rate cuts in the near term and an economy that weathers the storm, and subsequently the earnings picture remains somewhat bright. But they're changing their tune, investors that is, a little bit so far this year. But you're fully invested. How come?
We're fully invested because, first of all, it beats the alternative. Even though interest rates are a little higher, they're still not high enough to really achieve our clients' goals. So we invest for philanthropic families and for the mission-driven institutions that they love, and they need higher real returns than 2%, which is what we're getting, for example, in a 10-year Treasury. So we like the equities. We think next year's earnings are going to come in strong in the S&P 500. And relative to interest rates, we think that they're more attractive. We also think that North America is more attractive than the rest of the world. So we're fully invested here, overweighting relative to Europe. And we're overweight in what we think of as, in a sense, defensive growth stocks. So you mentioned not so much the Mag 7. The way we operate is that we have sort of enlightened indexing as a core program. And for families, we're doing that in a tax-advantaged way. But then we have a select group of active managers on top of that. And those active managers tend to be underweight the Magnificent Seven. This is a little bit of a market technical issue, but it's very hard to be at weight with the companies that are that large. So almost all active managers are slightly under the Magnificent Seven, and we're in these companies that are growing well but aren't as expensive as those ones are.
And so if there's a focus on defensive growth, does that mean that you keep an eye on technology companies? It's just that, that group that we'll just remind our audience, we're talking about Apple, Tesla, NVIDIA, Microsoft, Alphabet, Meta, essentially.
And we certainly own all those names. We just don't own them above weight. And as I mentioned, because of our active managers, we're probably slightly underweight. Technology it's not technology individually. Technology is affecting everything. We're sort of, some time ago, we're an investor in the private market side in venture capital firm Andreessen Horowitz. And several years ago, Mark Andreessen said that software is eating the world. He wrote an article about that in the Wall Street Journal. So we're really in an era that is it's like the Industrial Revolution or the introduction of the internet, where software and now AI, which is a sort of a version of that, and even crypto, which is a different way of writing software, blockchain technology. If you forget about the currency for a minute and just think about the technology behind crypto, those are all changing the way that software is written and applied while it's eating the world. So technology is key. This is one of the reasons we want to be fully invested, is we're in this point in time where things are changing across the globe based on new technologies.
In Canada, we have an outsized influence away from technology in banks and energy stocks. We're getting a taste on how the U.S. financial players are performing right now. It's been a busy week for earnings. Obviously, we're watching constant headlines around the oil market, but energy and financials in Canada, those two sectors alone make up 48% of the index. We showed our audience a graphic that would indicate you might have a little bit of cautiousness on groups such as that. Can you walk us through your thinking?
Well, we're underweight both those groups. And interestingly, if you look at Europe, for example, one of the reasons we're underweight Europe is that they are heavy in what we call deep cyclicals, so manufacturing and financials in particular, not so much energy. But we just believe that the growth is going to be on the other side in the technology and the growth companies. If you look at American banks and energy companies. They are performing really, in a sense, in line with Canadian companies in that same industry and also Europe. So if that group moved, we would underperform. And I would actually say that Canada and Europe would outperform. So that's a position we have on where we're overweighting these quality growth companies relative to deep cyclicals like banks, energy, and industrials.
Now, I saw in your list of individual stocks that might get into the sweet spot of what you like right now. I saw a name like Visa, and a lot of times Visa, Mastercard, we have our call-in show Market Call. These companies come up all the time. Some people don't think of them as technology companies per se. Others say absolutely you should think of them as technology companies. What are the dynamics with a business like Visa that make you bullish?
Well, it's a terrific business to begin with. Warren Buffett says, I'd rather be in a good company in a great industry than a great company in a good industry. So it's a great industry to be in. And the consumer is strong. So if we look at, there's been a lot of fear about the recession last year and what was going to happen. And part of that was the consumer was going to roll over. Well, that doesn't seem to be the case. We've got strong employment and interest rates are still relatively low. You got to remember, I've been in the business over 40 years, but I started my own firm 35 years ago. And when we started that business, the money market funds were at 10%. So, we have relatively low interest rates. And although they've ticked up lately, we think the trend is down. So, for example, with a 10-year treasury that's slightly over 4, if it got up toward 4.5, we would be buying longer maturities because we think the trend is down. So those are low rates. We've got strong consumers. Those are sort of the reasons we think companies and it's a great business and these payments companies. So those are some of the things we are slightly overweighted in. We own the other technologies. We own the industrials. We own the energies. We just overweight the group that we've talked about.